What's going on, guys? It is the Zoomer Value Investor here to talk to you guys today about some of the stocks I've been buying over the past month, the month here of May 2023. Now, I know I'm getting this video kind of towards the later part of the month. I really do apologize. I've been busy with some in real life stuff. So I am going to title this one kind of like May, June 2023. However, let's go ahead and get right into these. The first one I really want to talk about is 3M. This is a Minnesota-based multi-manufacturing company. Most of their revenues do come from their adhesive businesses. Their adhesive business brings in a revenue of something like $4 to $5 billion a year. And of course, 3M is a huge player in the healthcare sector as well. You think about 3M, you think about certain types of medical manufactured products that really only 3M does. I think one of the major ones that comes to my mind is things like medical tapes and surgical tapes. But ladies and gentlemen, here 3M is falling below $100 per share. That puts the price tag on 3M at $53 billion in market cap. Now, I really honestly think 3M is severely undervalued here, and I think a lot of that has to do with an overreaction from the market to a current lawsuit that 3M's going through. 3M's gonna have to do some type of settlement or payout for this lawsuit. I think in times with news stories and things of that nature, the market starts pricing in the worst, and I personally do not believe the worst will come. I believe it was certainly a top 5 biggest, huge medical healthcare company lawsuit settlement is like the Johnson & Johnson baby powder settlement, right? And it actually was close to a $10 billion settlement. It was, I believe, about an $8-9 billion case. But the thing about that is this settlement, the payments were ordered to be paid out. Oh, it was over a course of 20 years. And that's the thing about a lot of these settlements is that it's not like the moment that this thing goes through that 3M is going to have to give up all these cash, all these assets and stuff. And it's all these shareholders who liquidated their ownership of the company anticipating some events such as this. It's just simply not going to come. And I think it's going to be more so in the position where this is going to be a large incremental fine on 3M, not so much a one-time event that just puts an entire stupor on everything 3M's trying to do and just takes a whole bunch of its cash and assets all in one swoop. No, that's not what's going to happen here. For me, I've always thought of 3M personally as just a portfolio core, kind of a staple in anyone's portfolio. I think it's that good of a company with diversified revenue streams. I'm just saying, as the Zoomer Value Investor here, me seeing 3M trading at a price at below $100 per share, I'm honestly really watching for $90 per share to really load the boat. But I've certainly at least started buying this stock with a starter position because, this is a company where, outside of the lawsuit and things of that nature and that type of negative hullabaloo news, me able to get ownership of this asset at this price, I think it's phenomenal. I am entirely ecstatic with this because I really think this is a thing I can buy, and I just almost know it's going to be higher in 5-10 years. It's not really a huge brainer, not something I have to think about a ton, and it just has to do with this company just being that good of a core, more so in the economy as a whole. Really, when you dive into 3M's products, it's you almost go into any household, any office, any setting, in the modern world, and there's a 3M product in that vicinity. I think it's a pretty good bet here. Even with all the negative news and all that, I think that's really priced into the stock. Ladies and gentlemen, our next stock is CVS. Now, CVS is, of course, a local retailer, pharmacy type chain, obviously huge in the United States. They certainly have locations worldwide, but I'm of course most familiar with this business from my livings in the United States. And we are at a position where CVS has fallen to about $67 per share as I'm doing this video. And I really do believe that this is a very similar opportunity to 3M. I believe this is a little bit more of a growth story, though, compared to 3M. When I look at acquisitions that CVS has made recently, things such as Oak Street Health, I think, despite them having to obviously pay for these acquisitions, a lot of that kind of uncertainty, economic macro, kind of starting to hammer the stock a bit. But I think it's a really good time to step in as a buyer here, breaking, below that $70 resistance line finally. So I'm stepping in as a buyer, but I'm really watching honestly for, I think the stock could go into the 50s. Like I just kind of have that like weird hunch. So I'm not like buying all at once here, but it's like 3M, right? So it's just, I look at this and I go, this is just such a staple in worldwide healthcare systems. This should be at least $100 stock for CVS. It should be like way higher. It's kind of like 3M. I look at this and it's like, well, this should be like a $200 stock. So it's just, I think it's a pretty easy double. You just got to zoom out 3 to 5 years. It's hard to explain this because I feel like I'm repeating myself a lot when it comes to like, value investing methodologies and things of that nature. But it's just like, buy a good business, sit on it, wait, don't overcomplicate it. And the other thing I really want to throw out there is that Peter Lynch methodology of really you only have to be right like 6 out of 10 times, because investors will just happen upon that extreme upsides in the markets anyway. But I think I have really, really good odds here. So of course, like I'm taking these bets, and I feel like these are just really easy money stocks, you guys. And I'm just like, these are just no-brainer bets, and they're just like popping up everywhere. So I've been noticing a huge kind of like bubble in AI recently. Some stocks I own like Nvidia, Meta, Google even, they've been seeing a huge wicks of green candlesticks lately that are just really sudden and kind of out of nowhere. Obviously makes some value investors such as myself really suspicious when I start seeing things such as fluff and euphoria in the markets such as that. Fearful when others are greedy when others are fearful, of course, right? So I have been kind of in a situation where I'm slowly starting to sell off a little bit of Meta stock, quickly starting to sell off the little bits of Nvidia that I do own. I of course will never get out of like these companies. I don't believe in selling entirely. I'll always hold on to some type of like share ownership, but yeah, definitely good time to take profits. I really do think on a lot of these kind of like AI stocks. I think a lot of them are overbought, especially Nvidia. And it's just a time where I'm finding myself a pawn. Like I just have a lot of cash because I am, doing these taxable events of taking profits, on stocks. And I really would like to just get that capital back into the markets, back working for me. So I really just see these as like no-brainer opportunities, things like CVS, 3M, because they are in that more like defensive sector of healthcare. And I really think these are good like turnaround plays. These are of course like, I'm putting my money into like great cash generating businesses that like the world recognizes. So I think from that aspect, I feel like there's good security here. And I really think like this is just like lining up to a point where it's almost like just all it takes is the superpower of patience. And I think this will be a really good play. And worst comes to worst, maybe like I find a better opportunity other than 3M, and 3M like bottoms out around $90, right? So then I just like take profits there. I lost a couple percentage. You take a small loss on a trade or investment, that's not a big deal. That becomes like a tax harvestable event. Next thing you know, you have like pretty much all your capital back. Maybe you lost 5 to 10% of it, but you get a whole chunk of capital back in your hands. But the landscape of opportunity has changed. So, if we're in a situation where like Nvidia just sees like a huge rally down, like a huge collapse of euphoria, for example, right? And I get offered like $100 Nvidia stock, or I started buying it around $130. So I'm buying $100 Nvidia stock. I mean, that's a good place to be in, right? So that's what the opportunity landscape. The opportunity landscape changing, that's something that you really have to be ready to take advantage of. And I believe buying these kind of like lower beta kind of stocks, these defensive kind of stocks that are kind of oriented in the healthcare sector. Like one thing that comes to mind is also like Walgreens. I do own Walgreens, and I've talked about that here on this channel. And that stock, just look at that on the charts, right? I feel like that stock just has huge resistance around $30. And it's just like, obviously, with a PE around like 6 or 7, so much of that valuation is backed up by like just hard cash that business has, hard assets like their ownership of things like AmerisourceBergen. They own around like 10-15%, I think, of AmerisourceBergen. yeah, so, you know, with that being said, you just look at it and just kind of assess like, okay, this is a more like defensive stock. Like I can really like feel comfortable putting some capital here, and the sense that the upside maybe won't come like super quickly, but also I feel like, you know, the downside is it's negligible for the near term, and I think a lot of the downside has happened before I entered the stock, and that's the tactical advantage I really want to press into your mind here, the viewers, right? But then you look at a stock like Nvidia today, and you're like, okay, you know, I'm Billy Bob here, right? And I have like $10,000 to invest, right? And I'm looking around at the market and I go, oh, the $380 per share like Nvidia stock, you know? So Billy Bob gets all excited, right? And then next thing you know, Billy Bob's like, let me get like, what could Billy Bob buy? He could buy what? So like a little over 20 shares, like 25-ish shares, I think, for Billy Bob with his 10K, and buys it at $380 per share. A stock like Nvidia, as fast as it goes up, it can come down, right? When you're in the very exciting, you know, technology sector of things like graphics processing units, data centers, like very exciting stuff, of course, right? And they are the best. Like Nvidia's the best at what they do. But that's why, you know, it's hard to evaluate stocks like this. You watch my video about Tesla here on this channel, you know about this. It's like, this is straying from the realm of value investing a little bit when you start talking about a stock like Nvidia. But I feel like I, as the Zoomer value investor, I feel like I'm a pretty good arbiter about discussing stocks like this. And I really would say, if you're interested in this topic of kind of like stocks that stray from valuation norms like Nvidia, definitely go check out my Tesla video here on this channel. It's a great lesson in kind of like hype beast stocks and how they stray from the valuations. But going back to our example, so Billy Bob, he buys around his 25 shares in Nvidia. Well, you know, in like 2-3 months time, that Nvidia stock could be back below like $200. Like, you know, these stocks, they go, as fast as they go up, they can come down. And a lot of that has to do with Nvidia can't really support its valuation. You're talking about a stock that currently is something like above 30 times price of sales right now. I mean, that's lucrative stuff. You know, price earnings is in the hundreds right now, I believe, on Nvidia. Last time I was checking it. So, you know, you compare that like I was talking about like Walgreens, price to earnings of 6 or something like that. So like, let's literally break down what price to earnings is, right? If you don't know what that means. So that means the price of the business, the price you pay something like Walgreens, I think it's around like a 30 billion market cap company right now. That means that price of that $30 billion price tag, because, you know, stock price is irrelevant. All stock price is how many stocks are out there for this company and what is the current share price of those shares. So, you know, that's just all that stock price. It's literally just price of stock in USD per stock or per share times the amount of, like, you know, total shares for that company. And that's all it is. So market cap is really what matters. We want to know about market cap. So when market cap of the company goes up, that's how actually we get our, you know, the amount of our value in our, you know, share prices to go up. So our price tag, 30 billion on Walgreens, right? But they have earnings that are pretty strong, right? So, you know, if the company pulls in something like, you know, $5-6 billion of earnings every single year, then that's how you get something like that. You know, kind of like, that's a strong price to earnings rating, because the S&P 500 average on the price to earnings, I believe today is something like a 17 or 18. And that's because, you know, you have some stuff like XLK, which is the singularized technology sector within the S&P 500. And, you know, the XLK has a loftier valuation than most other businesses in the S&P 500. So really interesting if you're interested in looking into things like, you know, those indexes and whatnot. I would definitely consider that. It's really interesting stuff. But yeah, ladies and gentlemen, you know, I'm just with a lot of macro going on, and the S&P is seeing a crazy rally still in 2023. I will always be a buyer of stocks, but I'm buying defensive stocks a little bit more right now. Not buying so much risky stuff. I was buying a lot more of the risky stuff if you watched my videos back in around like November 2022, buying a ton of like AI stocks, talking about like Nvidia, talking about Google. But now I kind of like to buy the boring stuff that no one wants, while stocks like Nvidia are going to the moon and are once again nearing like $1 trillion in valuation, or maybe they surpassed that, I don't know. All right, ladies and gentlemen, so my last stock I really want to talk about here today is Brookfield. Now this is actually really interesting because I actually want to talk about two tickers within, you know, Brookfield, what I'm talking about here. So Brookfield, which is like a overlarging like parent company, right? And then they actually had a spin-off event recently of asset management. So BAM, Brookfield Asset Management, spun off from BN, which is Brookfield. You know, these financial entities, right? So I think these are actually both really attractive stocks here. I saw Monish Pobrai, super investor I really like to follow. He added Brookfield to his portfolio. So now his portfolio, as far as like US, kind of like Western world listed holdings, he only has like 2 in the whole Western world. This really famous investor, he only owns 2 stocks in the Western world. One, which is Micron, which is a company I've of course talked about here on my channel. Please do go check that out if you are interested in Micron. And the other one being Brookfield Asset Management. Now, what's so interesting about Brookfield Asset Management? Well, it spun off from Brookfield, so that means, you know, it spun off from a larger parent company. One thing you normally see in spin-offs is that these stocks kind of get disproportionately punished. A lot has to do with usually like dividend-focused shareholders, which, you know, Brookfield historically has been known to pay out dividends. So when they spin off these like entities, these like kind of like dividend-focused shareholders kind of like see these new companies. You'll hear the term a lot, newco, in financial jargon. That's all it means is new company. So when these new companies spin off from these parent companies, they show up as like a new ticker in their holdings in the portfolio. And a lot of these like dividend-focused shareholders go, I don't know what this is. I don't know anything about like the sub-business of this larger business I owned. So I'm just gonna like instantly sell this. And they just kind of like get in that kind of like mind state. As it kind of like trends down, they go, okay, yeah, I don't know about this and it's trending down, so I'm selling this. And it creates a snowball effect, right? And I personally think that's a little bit of what I've seen here with Brookfield Asset Management, and that's why I'm personally pretty attracted to it, because I looked into the new company a little bit, and they're actually really strong asset managers. They have compounded like, I believe around 30 to 33% annually for around like 20 years of involvement in Brookfield, you know, since establishment in Brookfield. So I think it's really, you know, when you combine that with just the fact that this is an opportunity to clone Monish Pobrai, and I've had success cloning him in the past. I cloned his Micron investment. Of course, you know, when I say clone, I am doing my own research as well on top of this, but it's just kind of complementative of, you know, my investment philosophy. When I see other people I do respect their philosophies, the research they've done, all the books they've read, as well as, you know, the more years of wisdom and just raw life that they've lived compared to me, the Zoomer value investor, I think that gives me a lot of confidence going into the investment and just reassurance that, you know, my research and that my mind is in the right place. So Brookfield Asset Management, I think, is really, really attractive here. Now, I actually think that Brookfield itself is very, very attractive here as well. And a lot of that has to just do with, you know, depressed stock price. And I think it's a really good time to buy a lot of financials just in general. As Warren Buffett says, banks will be higher in 20 years. It's almost like death and taxes, right? Now, I talk a lot about Citigroup. Citigroup's one of the banks I like the most, just because I think the way they're able to pass stress tests and things of that nature. And I think Citigroup's definitely one where, you know, ever since like the 08 financial crisis and stuff, they really have to like show the world still that they are kind of like their reputation is back. And I think that eventually will be priced in. You know, you see something like, we still have things going on like the SVB bank crisis and stuff like that. I think a lot of those reverberations and the economic macro with just the drastic rate of the interest increase we saw from the Federal Reserve happened very, very fast, a historically fast event, the fastest interest rate rise in history. Really hammered a lot of these assets. So because of a situation where, you know, companies like Brookfield, it becomes harder to refinance debt because the interest rate keeps going up. So they can't effectively refinance some of that debt. That hits their books, like their asset books, hard, because it's like, hey, we're not getting this debt refinanced at a better rate. That's matching the drastically changing macroeconomic environment we're seeing, a la caused by, you know, Federal Reserve hiking rates. So that causes environmentally based temporary distress that doesn't at its core penetrate healthy companies a ton, because once that environment changes, you know, the sun comes back out or whatever, then that company gets to kind of like shine again. So I think if you're willing to look past like the interest rate environment, kind of like the generalized issues that financial sector's going through right now, with like debt refinancing and things of that nature, I think that Brookfield looks really attractive here. Definitely consider adding both BN and BAM to your watch list.